So we got a 0.5% decrease in the OCR from 3% to 2.5%. That was largely priced into fixed mortgage rates already. We've got a 1 year out there at the moment at 4.49. That looks really attractive. That's what we were expecting to see after this OCR decrease, but because wholesale interest rates dropped earlier, banks passed that benefit on a little bit before the OCR change. 2-year rates around 4.65 and 3-year rates around 4.85 through to about 4.9. Those are all good rates. We're largely at the bottom of a cycle now, so I wouldn't expect to see too much movement in the rates. I think there's an opportunity that the 1-year rate could go a little bit lower, particularly if we get another OCR decrease before the end of the year. There's one more OCR announcement in late November, and then that's pretty much it until February. Whether or not the Reserve Bank drops another 0.25%, I think 50-50 on that. But I think the next OCR change will be the last decrease if we get one, because I think green shoots are starting to emerge. I think we'll come back in the new year. Kiwis will have benefited from these lower rates. Our agricultural sector is quite strong at the moment. So I think we'll be very much in recovery mode next year. A lot more positivity out there. That said, it is election year, and that's sort of shaping up to be quite interesting in the second half of next year. So recovery, but a little bit of uncertainty there in terms of it being an election year. As far as mortgages concerned at the moment, look, I'm very much a 50-50 guy. When we're at the bottom of a cycle, I think take advantage of the low rates. A 1-year rate below 4.5 looks really attractive, but maybe also put part of your loan on a longer term rate, particularly if you're rate sensitive. We are below what the Reserve Bank calls a neutral OCR now, which means that it's stimulatory, and it means that when the economy does start to recover, we should expect to see 1 or 2 rate increases coming through back to neutral. And I think neutral rates are sitting around that 5% mark. So, if you think about it in that context, those longer term rates with a 3-year rate around 4.9% look really attractive. And so I'd be splitting half on short term, half on something a bit longer. That way you've got to bet both ways, and no matter what happens, you're going to feel good.